Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, the US markets in particular have been off to the races over the last week and a half, I'd say. So we just seem to be hitting new highs.
Yes.
Can it continue, or are these markets looking very, very overstretched?
Look, they are stretched, but it's not to say that it can't continue. I'm going to show you the chart of the S&P 500 that's up on the screen at the moment. Last week when we were here, we alluded to the fact that this upward trend is still very much intact and that the S&P 500 had broken out above 2280, which was a resistance level. You can see that it broke out, then it came back and retested that area as support, and now it seems to have found some buying interest again. And certainly over the last 4 sessions, it's put on the gas and it's been moving higher and higher and higher. What is interesting to note now is that our RSI, that's the relative strength index at the top there, is now above 70. And that is always where you term a market to be overbought, officially overbought, if your RSI is above 70. It's not to say that it can't continue higher, or that it maybe if it doesn't keep going higher, maybe it tracks along sideways for a while. When you can see what happened back in December last year, where the RSI went above 70 and it stayed there for a while, and the market didn't really come down. It rather just tracked along sideways. So it's not to say that it's all going to fall down in a heap, but it is stretched. It is overbought, and you've got to say that very often when you get to this level of overbought in the market, you'd probably be brave to be chasing it at these levels. And
brave or unwise.
Brave or unwise. But then again, a market that is overbought can sometimes stay overbought. And I've thought for a while that after this breakout, it is possible that these markets, these US markets, actually start to really go into sort of a euphoric type of a rising situation. And that does appear to be what we've got on our hands at the moment. The Dow's through 20,000, this S&P 500 is making new all-time highs. These markets are not cheap, but it's not to say that they can't go higher and that they couldn't become a little bit more expensive. So I'd be very cautious on calling a top anytime now. But at the same time, I think you do have to be careful about chasing things as we stand right now.
Yeah, you'd certainly not be calling a top on the local market.
No.
Anything but.
No, not at the moment. We need to see how this plays out. So this is a chart of the top 40 index, and we obviously talk about this each week on the show. Now, what we've spoken about in the previous couple of weeks is this head and shoulders pattern that has been forming. And about 2 weeks ago, we said, watch out. It looks like it's going to form the right shoulder of that pattern. It did indeed form the right shoulder of the head and shoulders. And it started to break below the neckline. Now, the break below I think it's about 45,700 is the break below the neckline of that head and shoulders structure. And you can see the market did trade lower thereafter. The target from that head and shoulders pattern is actually 44,500, and it didn't quite get there. It missed it by a good couple of 100 points actually, and we've subsequently seen the market turning up, as you can see, over the last few days. Interestingly, yesterday we saw a day where there was quite a lot of profit taking in the afternoon session, and hence you get that long tail on the daily candle yesterday, that being Monday.
Yeah,
and today's market, today's market is weaker. So it looks as if we may actually be into another period of consolidation here. And I don't know whether we're going to go and retest those recent lows and possibly even tag the 50-day moving average, which is sitting a little bit down, little bit lower down here, or whether we sort of consolidate before another leg to the upside. It's very, very difficult to say with any certainty right now how this is going to play out. But we've had a couple of days of a sharp move up, and it certainly looks for now like some consolidation is beginning to set in on our market for the very near term anyway.
Yeah. Well, you're not fishing in local waters for the 2 stocks that you've actually entered into trades on this week. And the first is BHP Billiton. We did flag it last week, and this is a trade that you've actually gone into. Yes,
that's right. So the chart that's up on the screen at the moment is actually the slide that we showed last week. We have this new to watch in the week ahead section of the show, and this is the exact slide that we put up last week. And what I said is, take a look at BHP Billiton, notice this uptrend that goes back to the beginning of 2016, and notice that it seems to be pulling back, and you would expect that that upward trend, which has been very much intact for the last year, will probably attract some buying interest if the market gets down there. So watch out for that. And I said the support level was about £13.20. So if we fast forward a week now, there's the updated chart of BHP Billiton, and you can see what's happened is the market actually, or the stock, has pulled back to that support level. In fact, I said the support was at £13.20. The low last week was £13.19. So you can call me a liar for 1 penny. But it got there, it reversed up off of that level, and you can see the inset there. So what I've done is I've actually taken that trading action for the year to date effectively, and I've expanded it just to zoom in so it's more clear for the viewers to see. And there you can see the upward trend, and notice we had that doji candle which occurred off the uptrend support. That was on Thursday of last week. And BHP Billiton share price did push up off of that level. And I said last week that what I would probably look for is an opportunity to buy the stock if it reversed up off that uptrend support. And it did that. So the trade that I did was entered on Friday, actually. And I went long at £13.60. Now, obviously, that's higher than the £13.20 area that I was watching, but that's because I was waiting for a reversal to occur.
Yeah, okay.
I wasn't just going to blindly go out and buy it. I wanted to actually see evidence that other buyers were also seeing the same support level that I was, and therefore that we can all collectively take the price higher rather than me being the guy lonely looking to try and pick a bottom in it. So after having seen it reverse up off the support level, I went long at £13.60. My stop loss is £13.15, and I'm looking for a move back to the recent high, which is at about £15 or just above £15. So that's where we are at the moment. I've put a small trade on for this in this stock. Admittedly, it's a little bit annoying to see that it seems to it does appear that it's got a bit of selling pressure still at the higher levels right now. So, you know, I kind of hope we don't have a similar scenario to what we had on our MTN trade 2 or 3 weeks back, where we went long and it looked fantastic for the first day or two, and then it all turned around. But anyway, you know what? In trading, you've got to throw the line in the water to catch a fish. We've put the line in the water. Let's see what happens. If it doesn't work, we've got a stop loss to save us, and that's always an important thing.
So if you can talk us through the mechanics of that trade, because they're pretty much exactly the same as any trade that you'd be entering into.
That's right,
market.
yes. We've done this on the London Stock Exchange, of course. So that we've gone long at £13.60. The stop loss is £13.15. Risk per share, therefore, is 45p. I'm risking £100 only, so that's 1% of our capital. Now, remember, we started this year with our offshore account has got £10,000 in it, so 1% of that is £100. Doesn't sound like a lot of money, but when you times it by 17, it's a little bit more meaningful. So we take our capital risk of £100, divide it by 45p, and that gives us 222 shares. So I've rounded it off to 220 CFDs. And that's what we've traded for the portfolio in the last couple of days. My target here is £15, as I mentioned, and that therefore means that the risk-to-reward ratio on this trade is 1 to 3 and a bit, which is fine. That's a very decent risk-to-reward ratio, which I'm happy to take any day of the week.
Yeah. Now, you've actually entered into 2 trades this week, and the first, and you probably have a fair fundamental knowledge of BHP Billiton. The second is a company, and I imagine that it's almost on a pure technical basis that you'd be buying this group, because it actually is in the FTSE 250s,
Yeah.
the smaller shares on the London Stock Exchange.
Yes, that's it. So we say the smaller shares. I mean, it's still a pretty sizable company by our standards. It's a company called Weir Group, and it's actually it's an old company. It dates back to 1871, and it's been around, obviously that's what, 140 odd years. They started out making components and pumps and things for steamships, and the business has evolved over the years. But basically nowadays, in 2017, it's an engineering group, and it focuses on the oil and gas sector and the mining sector, and also in water, still providing engineering products into that sector. The company is headquartered in Glasgow, in Scotland, and as you mentioned, it's listed on the FTSE 250, which is I suppose if you want to call it the second tier in terms of large cap stocks on the London Stock Exchange, because you get the FTSE 100, which is the 100 biggest companies listed in London, and thereafter you get the FTSE 250. And what a lot of people get confused with is they think that the FTSE 250 is the biggest 250 shares. It's not. You get the FTSE 100, which is the first 100 shares by market capitalization, and then thereafter, number 101 up until number 350, that's the FTSE 250. So if you take
almost like our mid-cap index.
In a way, yes. Obviously, the companies that are listed there are much bigger. I mean, there are many companies that are on the FTSE 250 that would quite possibly make it into our top 40 index.
Yeah.
But that's obviously the function of it being a much bigger market.
Yeah. Okay, so Weir Group is, why has it caught your eye?
Well, it's caught my eye because technically it's got a very solid upward trend that goes back to the beginning of 2016 last year. And you can see recently it's broken out above some overhead resistance, and it seems to have been consolidating above that previous resistance, which now acts as support. Now, I want to zoom in more carefully on that recent trading action. So you can see that, again, is the year-to-date trading action for Weir Group. We've zoomed right in to make it clearer for the viewers. And what really got my eye from a technical perspective is the fact that this stock has actually been tracking along sideways in a range between about £19.70 up to £20.50. And you can see for 4 weeks, nearly 5 weeks, it's been bumping along up and down within that trading range. Now, last week, it broke down below the bottom of that trading range. It went and it flushed below the 50-day moving average, which is that red line at the bottom there. Now, typically, when you see a break down like that, you would say, well, that normally is considered to be a bearish break. However, what's happened subsequently is the share price has moved back up into the trading range. And that's what gets me excited, because this type of scenario very often will result in a violent break in the opposite direction through the top of the range. And the thinking here is that the sellers, the bearish traders, were not strong enough to push that price down once it broke below the bottom of the range. Instead, the buyers came in, they took that price back up into the range. And it's giving you a little clue. It's almost like the market showing its hand and saying, you can see from this trading action, the sellers were not strong enough to take that price lower. The buyers were strong enough to come in and push it higher. And that's where you very often find that you then get this violent push out through the other direction of the range. So if the technical rules are anything to go by, I won't be surprised if we see this share price breaking out through £20.50 and pushing on up into new highs from here. So based on that, I've taken a trade. I did this on Monday, so yesterday. I've gone long at £19.79. And I'm using a stop loss below £19.20, which effectively means below the bottom of that reversal candle that we saw last week, Thursday. And I'm going to look for a move up to about £21 here. And that's a conservative move, I think. It might even go a little bit higher than that. But my thinking is here to rather sell into an overshoot out the top of that range. We're not going to hang around forever. But I do think that there's a decent enough risk to reward ratio to take the trade here. And I'd be surprised if we see the stop loss being breached here, because already the buyers have shown their hand that they are actually quite strong in terms of this share price trading action. Well,
I suppose in the mechanics of that trade, you'll also show us what the risk to reward ratio is there.
We certainly will. So I've gone long at £19.79, stop loss £19.20. Risk per share, therefore, is 59 pence. Again, I'm only risking 1% of our capital here, so that's £100, which is 1% of our £10,000 starting capital. £100 divided by 59 pence gives us 169 shares, so I'm rounding that up to 170 CFDs. The target is £21, and as I said, that's a conservative target, I think. My risk to reward, therefore, is 1 to just over 1 to 2, which is fine. I'm happy with that.
Garth, I mean, both positions, just being 1% of the account, are fairly conservative, given that you don't have that many open trades at the moment. Yeah. What's the thinking there?
Well, that's it. I mean, these are the only 2 open trades that we have. Effectively, we came into this week with 100% cash in the account. It's 2 trades open, so I guess I'm just taking a conservative view that we've got 2 trades open at once, and I'm happy to split the risk between the 2. Possibly I could have been a bit more aggressive, but I'm also conscious of the fact that it is the beginning of the year. We're still just trying to get the runs on the board, and we sort of pushing to get those runs on the board. And I think once we got a little bit more of a safety net and a bit of a buffer to work with, possibly then I'd look at going in a bit more aggressively. But for now, I'm happy to just try and get my eye in, as the cricketers would say.
Okay, well, how is that featuring then as to the state of the portfolio?
All right, so we've obviously got 2 components to our portfolio. So the first is the Rand component, where we've just sitting on cash. We've only done 1 trade in this account, which was the MTN group, and that didn't work well for us. We took a small loss there, but I'm glad we took that loss. It would have been much worse if we had held on. So with this Rand account, we're actually still down 1% for the year to date. Nothing serious. I'm sure we can come back from that. And then on the offshore account, which we measure in pounds, you can see the trades that we've done recently. So BHP Billiton is this week's trade, and then Weir Group also is this week's trade. Both of those trades sitting with a small mark-to-market profit. And then obviously about 2 weeks back, we did a trade in the Royal Bank of Scotland where we made some money. So we're sitting with just under £10,300, so pretty much up £300 for the year to date, which is about 3%, which is fine. We're ticking over here.
Okay, well, let's hope for maybe some spectacular outbursts as far as the shares are concerned. Garth, and just to end off with a reminder that people can get a weekly alerts from subscribing to the site.
That's correct. If you go to traderscorner.co.za, you'll see that there's a link in the middle of the page where you can click on a free weekly email. It's very straightforward to subscribe to that. Just register, enter your details. It'll take you 30 seconds, and we will then send you a free email every Tuesday telling you what's coming up on the show for that week.
Okay, great. We'll leave it there. Garth, thanks as always. Garth McKenzie is founder and editor of Traders Corner.